Exchange-traded funds, ETFs, have revolutionized how investors access markets, offering transparency, accessibility and cost efficiency. 1. While physically replicated ETFs, where the fund buys and holds the underlying securities, remain the most common type, synthetic ETFs provide an alternative route and can, in some cases, deliver more efficient or precise index exposure. Among some of the potential benefits of this replication method are efficient exposure to emerging markets, EM, favorable tax treatment with US and global equities, and being competitive from a cost perspective when accessing European markets. As a leading provider of synthetic UCITS ETFs too, we see these considerations as important. Synthetic replication can facilitate efficient implementation of broad allocations that some asset owners seek for diversification. 3. Indeed, UCITS swap ETF flows in 2025 were strong, at around $46 billion, with robust interest from all regions of UCITS ETF buyers, including Europe and Asia. Synthetic ETFs in a nutshell. Synthetic ETFs, also known as swap ETFs, use derivatives, typically total return swaps with a counterparty, to replicate the performance of an index. Exposure via a swap can allow for a more efficient exposure of certain indices. This can translate into tighter tracking versus the benchmark, in more complex or less accessible markets. This structure sometimes prompts questions, but the reality is that over the past decade, the European synthetic replication framework has been significantly strengthened through enhanced regulatory oversight and the adoption of best practices by synthetic ETF issuers. These improvements increase the robustness and transparency of synthetic ETFs, making them a critical tool for accessing certain market exposures where physical replication may be less efficient or feasible. Benefiting from counterparties' scale and expertise. Another strength of synthetic replication is that the swap counterparty, typically a large investment bank, may be able to source securities under conditions more favorable than the ETF could achieve directly. Thanks to their scale, global presence and expertise, counterparties can often access markets more efficiently, trade with lower costs, or benefit from more favorable tax conditions. The synthetic structure means these potential benefits can be passed through to the ETF, which in turn may offer superior index performance relative to a physically replicated equivalent. Where synthetic ETFs can have the most impact. There are several areas where synthetic ETFs often demonstrate potential advantages over physical replication, with these exposures also favored among many asset owners in Asia. 1. EM exposures. Single country and regional EM indices can be challenging to replicate physically. Many of these markets are difficult to access, sometimes less liquid, more costly to trade, or require specific local arrangements such as opening accounts in country, trading in local currency, or navigating complex tax regimes. Some also impose foreign ownership restrictions. By using a swap, synthetic ETFs can overcome these hurdles, offering efficient exposure to these markets without the operational and regulatory complexity. 2. US and global equity exposures. Dividend taxation is a critical consideration when accessing US equities. Physically replicated ETFs are typically subject to a withholding tax of 15% to 30% on US equity dividends, depending on the fund's domicile. Synthetic ETFs, however, can benefit from more favorable treatment when tracking a so-called qualified index such as the S&P 500.5. In such cases, the swap counterparty can pass on close to 100% of the dividends, which can materially improve the net performance of the ETF compared with a physically replicated equivalent. This dividend advantage has been a compelling driver of demand for synthetic ETFs on core US benchmarks. 3. European equity exposures. European markets can also be expensive to replicate physically due to high trading and investment costs. Here again, synthetic ETFs can prove more competitive. Creation fees for synthetic funds can be particularly attractive, making them a cost-effective way to access European equities. Risk considerations and counterparty management. Of course, synthetic ETFs introduce considerations that investors must assess. The primary concern is counterparty risk, as the ETF relies on a swap with an investment bank. Yet this risk is not unique to synthetic ETFs. Many physical ETFs undertake securities lending, which introduces similar risks. The key thing, therefore, is for investors to understand how risks are managed and the benefits of the structure. At the same time, however, European regulations, UCITS and EMIR, require strict risk mitigation measures, including a maximum on the daily counterparty risk level as well as daily collateralization. 6. These frameworks ensure synthetic ETFs operate within a robust risk management environment. Within this context, choosing an issuer that employs a competitive multi-swap model, with strict control of substitute basket risk and daily resets, can provide an additional operational edge to performance. Transparency has also improved considerably. Today, ETF providers typically disclose replication methodologies, counterparty selection process, counterparty risk levels, collateral composition, and giving investors the information needed to evaluate the structure. A tool to add value in portfolio construction. Synthetic ETFs are not a replacement for physical ETFs, they are a complementary tool. Even for liquid and easily accessible markets, swap ETFs can be a good. And for harder to reach markets or indices where tax treatment or costs materially impact returns, synthetic ETFs can provide more efficient, precise, and, potentially, more rewarding access. For investors aiming to deliver optimal outcomes, understanding both approaches, and where each excels, is essential. Synthetic replication expands the toolkit, offering opportunities to enhance performance and simplify access to markets that would otherwise be cumbersome or costly to reach. 7. Building more efficient portfolios. Synthetic ETFs have matured into an integral part of the European ETF ecosystem. By leveraging counterparties' expertise, easing access to complex markets, and unlocking potentially favorable tax treatment, they provide investors with a practical, efficient way to capture index returns. In an environment where cost efficiency, precision, and transparency are paramount, synthetic ETFs should not be overlooked. They are more than just an alternative to physical replication, they are a powerful instrument offering the potential to build portfolios. Should you wish to understand more about Mundi's synthetic ETFs offering, or receive a copy of the synthetic ETF brochure, please contact us at etfasia@mundi.com. Knowing your risks. It is important for potential investors to evaluate the risks described below, and in the fund's Key Information Document, KID, for non-UK investors, or Key Investor Information Document, KID, for UK investors, and prospectus available on our websites www.amundiaf.com. Capital at risk. ETFs are tracking instruments. Their risk profile is similar to a direct investment in the underlying index securities. Investors' capital is fully at risk, and investors may not get back the amount originally invested. Underlying risk. The underlying index securities of an ETF may be complex and volatile. For example, ETFs exposed to emerging markets carry a greater risk of potential loss than investment in developed markets, as they are exposed to a wide range of unpredictable emerging market risks. Replication risk. The fund's objectives might not be reached due to unexpected events on the underlying markets, which will impact the index calculation and the efficient fund replication. Counterparty risk. Investors are exposed to risks resulting from the use of an OTC swap, over-the-counter, or securities lending with the respective counterparty IEs. Counterparty IEs are credit institutions whose names can be found on the fund's website amundiaf.com. In line with the UCITS guidelines, the exposure to the counterparty cannot exceed 10% of the total assets of the fund. Currency risk. An ETF may be exposed to currency risk if the ETF is denominated in a currency different to that of the underlying index securities it is tracking. This means that exchange rate fluctuations could have a negative or positive effect on returns. Liquidity risk. There is a risk associated with the markets to which the ETF is exposed. The price and the value of investments are linked to the liquidity risk of the underlying index securities. Investments can go up or down. In addition, on the secondary market, liquidity is provided by registered market makers on the respective stock exchange where the ETF is listed. On exchange, liquidity may be limited as a result of a suspension in the underlying market represented by the underlying index tracked by the ETF, a failure in the systems of one of the relevant stock exchanges, or other market maker systems, or an abnormal trading situation or event. Volatility risk. The ETF is exposed to changes in the volatility patterns of the underlying index relevant markets. The ETF value can change rapidly and unpredictably, and potentially move in a large magnitude, up or down. Concentration risk. ETFs can select a large portion of their assets in a particular issuer, industry, stocks or type of bonds, country or region for their portfolio. Where selection rules are extensive, it can lead to a more concentrated portfolio where risk is spread over fewer stocks. Where selection rules are extensive, it can lead to a more concentrated portfolio where risk is spread over fewer stocks. This can mean both higher volatility and a greater risk of loss. Important information. In Hong Kong, this material is for professional investors, and in Singapore, this material is for institutional investors only. Not for further distribution. This information is not for distribution and does not constitute an offer to sell or the solicitation of any offer to buy any securities or services in the United States or in any of its territories or possessions subject to its jurisdiction to or for the benefit of any U.S. person, as defined in the prospectus of the funds or in the legal mentions section on www.mundi.com and www.amundiaf.com. The funds have not been registered in the United States under the Investment Company Act of 1940 and units/shares of the funds are not registered in the United States under the Securities Act of 1933. This material reflects the views and opinions of the individual authors at this date and in no way the official position or advices of any kind of these authors or of Mundi Asset Management nor any of its subsidiaries and thus does not engage the responsibility of Mundi Asset Management nor any of its subsidiaries nor of any of its officers or employees. This research is not an offer to sell or the solicitation of an offer to buy any security in any jurisdiction where such an offer or solicitation would be illegal. It is explicitly stated that this document has not been prepared by reference to the regulatory requirements that seek to promote independent financial analysis. It does not constitute a personal recommendation or take into account the particular investment objectives, financial situations, or needs of individual clients. Neither Mundi Asset Management nor any of its subsidiaries accept liability, whether direct or indirect, that may result from using any information contained in this document or from any decision taken on the basis of the information contained in this document. Clients should consider whether any advice or recommendation in this research is suitable for their particular circumstances and, if appropriate, seek professional advice, including tax advice. Our salespeople, traders, and other professionals may provide oral or written market commentary or trading strategies to our clients and principal trading desks that reflect opinions that are contrary to the opinions expressed in this research. Our asset management area, principal trading desks and investing businesses may make investment decisions that are inconsistent with the recommendations or views expressed in this research. This document is of a commercial nature. The funds described in this document, the funds, may not be available to all investors and may not be registered for public distribution with the relevant authorities in all countries. It is each investor's responsibility to ascertain that they are authorized to subscribe or invest into this product. Prior to investing in the product, investors should seek independent financial, tax, accounting and legal advice. This is a promotional and non-contractual information which should not be regarded as an investment advice or an investment recommendation, a solicitation of an investment, an offer or a purchase, from Mundi Asset Management, Mundi, nor any of its subsidiaries. In Hong Kong, the issuer of this document is Mundi Hong Kong Limited. This document is not intended as an offer or solicitation with respect to the purchase or sale of securities, including shares or units of funds. All views expressed and/or reference to companies cannot be construed as a recommendation by Mundi. Opinions and estimates may be changed without notice. To the extent permitted by applicable law, rules, codes and guidelines, Mundi and its related entities accept no liability whatsoever, whether direct or indirect, that may arise from the use of information contained in this document. This document is for distribution solely to persons permitted to receive it and to persons in jurisdictions who may receive it without breaching applicable legal or regulatory requirements. Any dissemination, reproduction, copy, modification or translation in whole or in part, with respect to any information provided herein is forbidden. This document is for professional investors only and not for retail investors. This document has not been reviewed by the Securities and Futures Commission in Hong Kong. This document is prepared for information only and does not have any regard to the specific investment objectives, financial situation and the particular needs of any specific person who may receive this document. Any person considering an investment should seek independent advice on the suitability or otherwise of the particular investment. Investors should not only base on this document alone to make investment decisions. Investment involves risk. The past performance information of the market, manager and investments and any forecasts on the economy, stock market, bond market or the economic trends of the markets are not indicative of future performance. Investment returns not denominated in HKD or USD is exposed to exchange rate fluctuations. The value of an investment may go down or up. This document is not intended for citizens or residents of the United States of America or to any U.S. person, as this term is defined in SEC Regulation S under the U.S. Securities Act of 1933. In Singapore, this document is issued by Mundi Singapore Limited, company registration number 198900774E, who is regulated by the Monetary Authority of Singapore. This document is for information purposes only, is not a recommendation, financial analysis or an investment advice and does not constitute a solicitation, invitation or offer to purchase or sell any product. The information contained in this document is intended for general circulation without taking into account the specific investment objectives, financial situation or particular needs of any particular person. The information contained in this document is as of the 30th of September 2025 except where otherwise stated. The information contained in this document has been obtained from sources believed to be reliable but has not been independently verified, although Mundi and its affiliated companies, collectively Mundi, believe it to be fair and not misleading. Opinions expressed in this document are subject to change without notice. Mundi does not accept liability whatsoever, whether direct or indirect, that may arise from the use of information contained in this document. Mundi and its associates, directors, connected parties and/or employees may from time to time have interests and/or underwriting commitments in the securities mentioned in this document. Past performance and any forecasts made are not necessarily indicative of the future results. Any forecast, projection or target is indicative only and is not guaranteed in any way. All investments involve risks and the amount received from such investments may be less than the original invested amount. Mundi does not guarantee that all risks associated to the securities mentioned herein have been identified, nor does it provide advice as to whether you should enter into any transaction. This document is solely for issue in permitted jurisdictions and to persons who may receive it without breaching applicable legal or regulatory requirements. The information contained in this document is personal and confidential and shall not, without prior written approval of Mundi Singapore Limited, be copied, reproduced, modified, or distributed to any third person or entity in any country. This document is not for distribution and does not constitute an offer to sell or the solicitation of any offer to buy any securities or services in the United States or in any of its territories or possessions subject to its jurisdiction to or for the benefit of any U.S. person, as this term is defined in SEC Regulation S under the U.S. Securities Act of 1933. This advertisement or publication has not been reviewed by the Monetary Authority of Singapore. Information reputed exact as of the 30th of September 2025. Reproduction prohibited without the written consent of Mundi. Sources. 1. Investment involves risks. For more information, please refer to the risks section below. 2. IAUM, as of December 2025. 3. Diversification does not guarantee a profit or protect against a loss. 4. French or Luxembourg physical funds are subject to a 30% withholding tax rate on U.S. equity dividends, and Irish physical funds to a rate of 15%. 5. Under U.S. Regulation 871M, certain derivative contracts referencing qualified indices may receive more advantageous tax treatment. 6. UCITS, Undertakings for Collective Investment in Transferable Securities, European Directive 2014/91/EU. EMIR, European Market Infrastructure Regulation, Regulation No. 648/2012. 7. Investment involves risks. For more information, please refer to the risks section below.